Welcome. In this video, we'll walk through our LBO model, examining it from the perspective of an associate banker engaged in a live deal. Keep in mind that the structure and assumptions used in any transaction are ultimately decided by the parties involved. For demonstration, most inputs here are placeholders. We recommend having a copy of the LBO model open to follow along more effectively. Imagine we've just had a call with the managing partner about a potential buyout of a real estate tech company. Our task now is to input the initial information into the LBO template. Here are the key inputs we'll use. The target company is a Singaporean real estate tech firm, PropertyGuru. The deal has a purchase price of $1.1 billion and is expected to close in December 2024. For debt financing, we'll use a leverage ratio of 12x debt to EBITDA, structured with three types of debt: a line of credit, a revolver, senior debt, and mezzanine debt. With this information entered, the transaction section of the model automatically calculates key metrics. For example, we see the entry multiple calculated based on the enterprise value and EBITDA from recent financial data. We also see the equity value calculated immediately. In the sources and uses section, we've applied a 12x debt to EBITDA multiple. The other inputs here are placeholders, allowing us to move forward in building out the model. From these inputs, we can determine the total capital requirement, including fees associated with the transaction. Below sources and uses, you'll find the pro-forma equity section, showing the equity structure post-LBO, both pre- and fully diluted. Directly below is the blended cash interest, breaking down interest rates for each type of debt. The rates here are placeholders and can be adjusted to reflect final agreed upon terms. Below is the pro-forma balance sheet. You'll immediately see the changes in the company's financial position post-deal closure, scheduled for December 2024. You can clearly see the balance sheet's impact pre- and post-deal. The source column reflects the new debt and equity injected into the business, while the use column shows how funds paid to the seller and transaction fees are reflected in the balance sheet. Moving to the operating model, the exit multiple is initially set equal to the entry multiple. Adjusting this will affect both the exit enterprise value and the returns, ROI and IRR. Now, let's move on to the key outputs. We can see projected returns over the forecasted period based on these initial assumptions. Assuming we exit after 5 years, here are the returns for limited partners, the seller, and private equity sponsors. Based on our initial assumptions, you may notice some fails in the debt covenant section. This suggests the assumptions may be aggressive, and we could face lender pushback on the company's ability to meet debt obligations. You can also see a summary of key parameters under model check. Since there are fails in key areas, we may need to adjust the assumptions, which we'll do in the next step. Let's say that, after further due diligence, we determine that the company's value is closer to $900 million. The managing partner also wants to reduce leverage to avoid excessive lender pushback. With this updated information, we adjust the purchase price and debt multiple accordingly. The initial $1.1 billion purchase price is now $900 million. You'll notice the entry multiple and equity value are lower, reflecting the lower purchase price. The same applies to the exit multiple. Sources and uses are also updated accordingly. In the pro-forma balance sheet, all changes are reflected automatically, with most accounts showing a decrease except for equity, due to the new financing structure. Let's review the returns in the operating model. The IRR and ROI have decreased slightly due to the lower valuation. However, the reduction is modest, as we've also adjusted the financing structure, requiring more equity. Finally, let's revisit the debt covenant section. You'll see a notable improvement, with more passes than fails, indicating the company can meet most debt obligations under these revised assumptions. It's not uncommon to see some fails initially, as new ownership may need time to implement operational improvements. A practical approach here could be to negotiate a covenant holiday with lenders, providing a few months of flexibility as improvements are made. That concludes this session. In future videos, we'll explore advanced adjustments to the LBO model. Thank you for watching.